Our session is on business valuation. In this session, we take the project or business discount rate covered in the previous session and apply it to the valuation of a new business line or project. We cover business or project valuation equation, the business or project discount rate, the business or project cash flows in terms of the cash flow components, measuring cash flows to a valuation horizon, and horizon valuation. Then we calculate total business value, and we review some project or business valuation rules. In practice, the value of a business or project is usually computed as the discounted value of cash flows out to a valuation horizon plus the horizon value, which depends on cash flows beyond the valuation horizon. The horizon value is sometimes called the terminal value or salvage value. The value of a business or project can be calculated using the business valuation equation, which is made up of two pieces of a present value calculation. The first is the present value of cash flows from years 1 through H, where H is the valuation horizon. And the second piece is the horizon value, which depends on cash flows beyond the valuation horizon. Present value is calculated using a risk-adjusted discount rate, as we discussed in the previous session. The business or project discount rate is determined using the methods and principles described in the previous session. Let's take the example in the text of Sangria Corporation in its evaluation of Rio Corporation. As described in the text, we can use Sangria's discount rate of 9% to evaluate Rio because Rio and Sangria are in the same business. So we'll use a project discount rate of 9%, which reflects Sangria's overall company cost of capital. The distinction between net income and cash flow can be understood more completely by considering an equation that converts net income to cash flow. So here is the cash flow equation. We start with earnings before interest, taxes, depreciation, and amortization, also known as EBITDA. We subtract depreciation and amortization to arrive at profit before taxes, sometimes called EBIT. We subtract taxes to come up with profit after taxes, or EBIAT. Note that profit and taxes are figured as if the business is all equity financed. To arrive at cash flow, we need to make 3 adjustments to this version of net income, or 3 adjustments to EBIAT. First, add back depreciation and amortization, the non-cash expense components. Second, subtract the value of investments in capital assets or cash outflows required for additions to capital assets. Third, subtract the value of investments in working capital or cash outflows required for additional current assets necessary for the new business. With these adjustments, we arrive at cash flow, sometimes called free cash flow or net cash flow. In the Rio example, the new business cash flow in year 1 is 3.5. Let's see how RIO's cash flow is determined. Here we're looking at a spreadsheet entitled Sangria Evaluates RIO. Let's consider the information we have available in the latest operating year for RIO. As you can see, in the latest year, RIO's sales are 83.6, cost of goods sold are 63.1, to yield an EBITDA of 20.5. Depreciation in the latest year is 3.3, so we have a profit before tax, or EBIT, of 17.2. Taxes are 6, so profit after taxes, or EBIT, is 11.2. Sangria's evaluation of RIO, or the acquisition of RIO, depends on cash flow projections into the future. So let's start with projections of cash flows in year 1. An initial step is to estimate or project sales in the first year after the acquisition. Sangria expects to be able to grow RIO's business above the experience in year 0 by, let's see what they've used here. If we scoot down, we can see that the sales growth assumption in the first year is 7%. So if we apply that 7% growth assumption, we arrive at a sales projection in year 1 of 89.5. For the next line down, cost of goods sold are assumed to be 74% of sales, which comes to 66.2. The difference between these two components, essentially the main cash inflow component and a principal cash outflow component, gives us EBITDA, or earnings before interest, taxes, depreciation, and amortization. Depreciation expense in year 1 depends on projected net fixed assets in year 1 and an assumption about the percentage of net fixed assets that are written off as depreciation expense. So as you can see, Sangria projects net fixed assets in year 1 to be 70.7 and is assuming that 14% of net fixed assets are written off as depreciation expense, giving us 9.9 in depreciation expense in year 1. The difference between EBITDA and depreciation gives us profit before tax, or EBIT. The tax in year 1 is determined by taking profit before tax, this version, I should say, of profit before tax, EBIT, and multiplying it by the marginal tax rate. And you can see the marginal tax rate is assumed to be 35%. So we subtract this tax estimate of 4.7 from EBIT to give us profit after taxes, also called EBIT. And note that this profit after tax is calculated assuming that Rio is all equity financed. To convert from profit or net income after tax to net cash flow, we have three additional adjustments. Here's our net cash flow, which we're trying to determine, which is 3.5. And you can see how that 3.5 is calculated. We start with profit after tax here, add back depreciation expense, which is our non-cash expense, then subtract the investment in fixed assets, or the cash required for additional fixed assets or capital assets, and then we subtract the investment in working capital, or the additional working capital or additional current assets that are required to operate this new business. So adjusting net income after taxes, or EBIT, for depreciation expense, investment in fixed assets, and investment in working capital, we get our free cash flow, or net cash flow, or cash flow in year one of 3.5. Once we have a projection of cash flows to our valuation horizon, we can calculate the present value of the business to the valuation horizon using the discounted cash flow method. Note that the valuation horizon might depend on the time it takes to get a business stabilized. In the example in the text, the Rio valuation horizon is 6 years. And here's a representation of the present value of the cash flows calculation. Based on these numbers, the business value of Rio to the horizon is $20.3 million. Let's see how this number was determined. I've highlighted the projected cash flows for years 1 through 6, where year 6 is the valuation horizon. In this cell is calculated the present value of those cash flows. You can see that to calculate the present value of the cash flows, we've used the net present value function, or the NPV function. The discount rate is the 9% company cost of capital for Sangria, and the cash flows are those that occur from years 1 through 6. And we get our $20.3 million. So we've calculated the first component of the business valuation equation, which is the present value of cash flows to the valuation horizon. The second component of business valuation, or the business valuation equation, is the calculation of the horizon value. Horizon valuation starts with the determination of the value of the business at the horizon. For this purpose, a business is often assumed to be either a stable going concern or a steadily growing business. To calculate the horizon value for a stable or no growth future, you use the perpetuity formula that we covered in a previous session. In this context, the present value at the horizon of a no-growth firm is equal to the cash flow in the year H plus 1 divided by the discount rate. This calculation gives us the horizon value for a no-growth firm. To determine the horizon value for a business with growth potential, we use the growing perpetuity formula. Here the present value of a business at horizon is equal to the cash flow in year H plus 1 divided by R minus G, where G is a projected growth rate. This calculation gives us the horizon value for a business with growth potential. Because the cash flows associated with the horizon value begin in year H plus 1, we need to determine the present value of the horizon value by discounting the horizon value back to the present. And this calculation gives us the present value of the horizon value. Let's apply horizon valuation to the Rio business. First, we need to calculate the horizon value, which is going to be equal to the cash flow projected in year H plus 1, which in our example is year 7. And we're going to divide that by R minus G. So our cash flow projected in year 7 is 6.8. Our discount rate is 9%. Our projected growth rate is 3%. So the result is a horizon value of 113.3. Now this horizon value occurs in year 6. So we need to discount this horizon value to determine the present value of the horizon value. And we do that by taking our horizon value and multiplying by 1 divided by 1.09, and the result is a present value of the horizon value of 67.6. Here's how the horizon value is calculated on the Rio valuation spreadsheet. In this cell you can see the calculation of the horizon value, which is shown as the cash flow in year 7 divided by the difference between the discount rate and the growth rate. Here, to get the present value of the horizon value, we divide the horizon value by 1 plus the discount rate raised to the power of 6, which is the valuation horizon. Finally, to determine total business value, we add the present value of the cash flows to the valuation horizon to the present value of the horizon value. And for the Rio Corporation example, here are the numbers. We found that the present value of cash flows to the valuation horizon was 20.3, and the present value of the horizon value was 67.6, giving us an overall present value of the business of $87.9 million. Here are some business or project valuation rules that will serve as a kind of summary of many of the concepts and points that we've made in the most recent sessions. First, for project discount rates, you want to use the rate required by investors in the project. Start by determining the company cost of capital. Make sure you adjust for the income tax deductibility of interest expense, and then adjust for any risk differences between the project and the overall business lines of the firm. To determine project cash flow, start with net income, but you need to make several adjustments. First, make sure you don't deduct interest expense from net income. Interest expense is going to be reflected in the discount rate. Calculate taxes as if the company were all equity financed. The tax implications of debt are reflected in the discount rate as well. Make sure to add back depreciation expense, which is a non-cash expense. And finally, adjust for any changes or investments in capital assets and working capital. With regard to horizon or terminal valuation, note that you actually have a choice. You could forecast cash flows either to the end of the project or to a horizon year. If you forecast cash flows to the end of a project, then there's no need for horizon or terminal value calculation. But if you forecast cash flows to a valuation horizon, then you need to determine the present value of the horizon value. But in so doing, be very careful in estimating a terminal or horizon value, because the horizon value often accounts for the majority of the value of a company or a project.